Hi everyone. Today, the 12th of April 2010, we're going to look at the stock market, the Eurostoxx50 index. This is going to be a medium-term analysis ranging from 2006 to 2010, and we shall be using a weekly bar chart. We can distinguish two major trends since the market peaked at 4572 in June 2007, the first one being the big drop to the March 09 low made at 1765, followed by the channel that delimits a subsequent bounce and provides support at 2777 and resistance at 3446. Interestingly enough, this drop lasted 21 months, while the current bounce is in its 13th month, which means that at present, the rise from the March 09 low is 61.8% in duration of its preceding drop. The wave count assumes that the June 07 high is a wave 2 of primary degree, and that wave 1 of 3 bottomed in March 2009, while wave 2 of intermediate degree might be complete at 3044 last January, where wave C is exactly 100% of wave A. Alternatively, wave C might have started at 2617 last February, and may therefore extend to be 38.2% of wave A at 3106, with the next resistances being at 3169, which is 50% of the preceding drop, and 3408, the 61.8% extension level, and finally 3500, the major 61.8 retracement mark, which will be met by channel resistance in May. At present, the market is still trending higher and the stochastic oscillator is pointing upwards, but I would like to point out some negative divergence here as we are challenging the 3044 high, given that the stochastic has yet to reach its January level and remains well below its August 2009 peak when the market was trading around 2800. Likewise, this oscillator mapping the difference between two moving averages has been declining steadily since late last year in another show of negative divergence, which is in contrast to some positive divergence we saw in early 2009 when the market bottomed in March, whereas this indicator started sloping upwards a few months earlier in late 2008. This basically means that the bounce from the 1765 low is slowly but surely starting to run out of steam, which is not going to say that we should sell the market outright here, but I would definitely advise taking some chips off the table, especially upon a break of channel support currently at 2777. In that case, we shall closely monitor retracement support at 2555, which is 38.2% of the preceding bounce, followed by the major 2254 level, which is 61.8% and just above the July 09 low. Indeed, if we break below that level, brace yourself for another major sell-off, as wave 3 of 3 will be expected to be at least equal in magnitude to wave 1 of 3, which for reminders was a drop of 61%. The bottom line is that I believe the Eurostoxx50 to have peaked last January, or it's in the process of peaking, with perhaps an added upside potential from current levels of between 5 and 15%. However, our various momentum indicators point to a year-long rally which is standing on its last legs. We shall therefore remain extremely vigilant in view of the next major sell-off ahead.